We are diving deep into the final closing bell of 2025. We've got the institutional reports right here, detailing the action from Wednesday, December 31st.
And our mission is pretty clear. We need to unpack this paradox. We just closed a historic banner year, but this final session, it felt less like a celebration and more like a quiet, defensive whimper.
A whimper is a good word for it. Let's get right to the scoreboard for the session that just wrapped, because these numbers do not scream victory lap.
Not at all.
The S&P 500 closed down 0.14%.
Right.
The Nasdaq, which really powered this rally all year, was the biggest laggard. It slipped 0.24%, and the Dow finished lower by 0.20, a sea of red to close out a colossal year.
And that context is absolutely crucial. Today's slight losses are, they're basically just noise compared to the big picture.
Okay, so frame that big picture for us.
Despite this little downward drift today, 2025 was an unqualified historic win. The S&P 500 locked in its third straight double-digit annual gain. It finished the year up a staggering 17%.
17%.
So the real question for us is, why did the market choose today, the day everyone should be toasting that 17%, to look so nervous?
Okay, let's unpack exactly that. The market finished red for the fourth straight session. It confirms that choppy mess our sources were calling for this week.
Yep.
This was supposed to be the Santa Claus rally, thin volume, stocks drift higher. So what drove this year-end fade? Why did Santa fail to show?
It's a liquidity vacuum. Hands down, that's the root cause. A severe liquidity vacuum and just a critical lack of institutional conviction.
So when you look at the price action today,
You have to look at the volume data behind it. We were essentially trading on fumes.
how thin are we talking? Give us the statistic that really anchors this.
Trading volume was absolutely anemic. It was trailing the 20-day average by approximately 44%.
44%, so nearly half empty.
Think about that. The trading pool was nearly half empty. That means these marginal downward moves we saw were just exaggerated noise. This was not a structural shift driven by, real money placing new bets.
So if the big institutional desks had, as you say, locked the doors, what was actually moving the tape? What mechanical pressures were still active in a market this thin? Was it just tax loss selling?
You nailed the two main drivers. First, tax loss harvesting. Absolutely. Funds are selling their losers to offset those massive gains from, say, the AI supercycle names.
And that selling becomes super visible when there are no buyers.
Exactly. No one is there to absorb it. And second, automated rebalancing. The big passive funds, the ETFs, they're all pre-programmed to adjust their weights for year-end, which just added to that slight constant selling pressure.
So the big picture then is that capital is actively moving to the sidelines. Professionals are fading this rally. They're banking the easy money.
And de-risking. They're choosing to de-risk ahead of 2026 instead of playing around on thin volume. They've already won the game for 2025. Now they're protecting the lead.
Okay, this is where it gets really interesting, though, because if the S&P just closed this banner year, why did the final action feel so weak? It points to a really critical divergence, right, between the headline price and the market's underlying health.
And that divergence is the most critical signal we got today. It's what the institutional desks are calling internal rot.
Internal rot.
Yeah. The S&P 500 is hovering near that historic 7,000 milestone. But if you look underneath the hood, that rally is supported by just a handful of names.
Okay, give us the hard data on that breadth collapse. How deep is this rot?
Let's start with breadth. The advanced decline ratio ended the day at 0.8 to 1.
So for every stock that went up,
For every stock that managed to move higher, 1.2 stocks were actively underwater. That signals a highly fragmented, very defensive close.
that's concerning. But the Nasdaq data you pointed out, that's truly staggering.
It is the smoking gun. While the S&P managed to post, 3 new 52-week highs?
Okay.
The supposedly growth-driven Nasdaq recorded a staggering 205 new 52-week lows.
205. On a day, the S&P is essentially flat. That defines a top-heavy structure. So explain this Brittle Bull concept for us. Why that specific term?
Brittle Bull means the structure is easily broken. It relies too heavily on too few pillars. We estimate the top 5 mega-cap names alone, the big AI winners, they drove something like 82% of the S&P's total gain for the year.
82% from just 5 stocks.
Right, so fund managers are holding those winners for the year-end snapshot, making the index look healthy. But most other stocks have seen their liquidity just an exit. The market is long on price, but decidedly short on participation. It's strong at the top, but it is hollow underneath.
Okay, so a top-heavy structure, a liquidity vacuum, that usually leads to apathy and volatility, but the VIX is telling a completely different story. It's telling a story of fear, not complacency.
Typically, yeah, the VIX just dies a quiet death on New Year's Eve. It settles into the low double digits, but not today. The VIX actually rose. It was up 0.9% to 14.33. It just refused to go into its holiday slumber.
What does that signal?
It's like seeing everyone cheering at the end of a race, but the security guard is still holding up their riot shield. They're waiting for something specific to happen.
Which tells you smart money is actively paying up for insurance. They're buying protection. Protection against what exactly? What's fueling this anxiety?
They're hedging against a potential January 2026 data bomb. There's some fresh trauma from those divided Fed minutes, and the memory of the April tariff shock is still lingering.
And the options market is pricing this in.
It is. The implied volatility figures show it. Short-dated options are pricing in a noticeable plus or minus 36-point move for the very first session of January. They are hedged for turbulence.
Let's shift away from the indices then and look at the outliers. The few green shoots where money did find a home today.
Right, defying that vacuum.
Energy, the XLE, was the leader, up 0.8%, which is a classic defensive signal in itself. But what were the specific conviction stories that broke the mold?
There were 4 key stories that showed genuine conviction. Gives us a little peek into where capital might flow in Q1. First, the crucial tech outlier, Meta platforms. Meta. While the rest of big tech was dragging, Meta climbed impressively, moving between 1.1% and 1.9% on heavy relative volume.
And the catalyst was real news.
It was a concrete strategic announcement, acquiring a Singapore-based AI startup called Manus for over $2 billion. This isn't noise. It's a statement that their AI spending plan is accelerating. It gives bulls a real reason to buy.
A powerful, fundamental catalyst. Okay, what about a pure technical setup? What breakout did we see today?
That would be Under Armour UAA. It surged 7.5%. We're calling this one a billionaire breakout, driven by news of a major stake increase by Fairfax Financial.
But the technical picture is the key.
That's what matters most. UAA closed above a critical long-term declining trend line. That line had capped its recovery for over 18 months. This close signifies that the stock has potentially moved from consolidation back into a structural uptrend.
We also saw AXT Inc., AXTI, pull off an incredible intraday reversal. Let's break down that intraday flip.
It's a textbook example of how institutional buyers rescue a stock. AXTI opened down a brutal 15%.
On dilution fears.
Exactly. Fears of a new capital raise. But it completely reversed to close up 8.3%. Strong institutional demand for their $100 million offering just soaked up all the supply. What started as a fear trade flipped into a high-conviction growth trade by the closing print.
It signals funds are still desperate for solid growth stories.
Even at high prices.
And finally, let's look at the safe haven trade that signaled instability.
Silver XAG. It staged a violent 7 to 10% V-shaped bounce. This was after a nasty 10% plunge earlier in the week, so the rebound was even more dramatic. The driver was clear. Geopolitical flare-ups in Venezuela and the Middle East, a rapid flight to hard assets.
Okay, let's tie this all together. The market's in a liquidity vacuum sitting on a brittle bull, and the options market suggests fear. What are the key technical levels you need to watch when the real money returns on Monday, January 5th?
The main takeaway is simple. Avoid chasing any thin volume moves early next week. Neutral sentiment is the only sensible call right now. But we do have 2 absolute lines in the sand for the S&P 500 ETF, SPY.
And before we get to the short setup, let's talk about that 690 level on SPY. What exactly is a gamma wall, and why focus on the ETF, SPY, instead of the index itself?
Great question. We focus on SPY because the options contracts, which drive these dynamics, they trade directly on the ETF. And that 690 level, that's the dominant ceiling. That's the gamma wall. Meaning options dealers are heavily long gamma there. They have to hedge their books by buying and selling the underlying stock, and it effectively pins the price like a giant magnet. If we hit 690, expect the price to just stall out. It's the ceiling we have to reclaim.
And the downside pivot point, where's the floor?
The structural pivot for SPY is 688.20. That is the true line in the sand. If we lose 688.20, we enter negative gamma territory.
And negative gamma means?
Think of gamma like the market's brakes. In negative gamma, it's like you cut the brakes. The downside accelerates much faster because the dealers, who are normally a buffer, are now forced sellers to balance their books. That would fast-track a move right toward the 685 demand zone very quickly.
The levels are set. Now, that high conviction setup for the first trading day, January 2nd. Tell us about this January 2nd, Jinx.
Our sources suggest a short trade on SPY. You could use 0 DTE or 1 DTE puts right at the January 2nd open. This is based purely on historical tendency.
Yeah, which is?
The first trading day of the year has historically been weak, a median drop of about 0.3%. And given we just closed red for 4 straight days, the probability of that slide continuing is statistically high, about 65%.
So the play is looking for a failure right at that 690 gamma wall early in the day.
Exactly. This is a volatility expansion play. You expect retail flow to try and buy the new year, new high hope rally at the open. You expect that rally to fail immediately at the 690 gamma wall and then accelerate down toward that 688.20 pivot, trapping the dip buyers.
But for those looking for fresh inflows, for the long side, what are the high conviction day 2 play setups once the dust settles? You have 2 names for us.
We have two high momentum, high value names we see on institutional shopping lists. First is TSM, Taiwan Semiconductor. TSM actually showed relative strength today. It outperformed the Nasdaq.
And the pattern.
It's watching a very clear ascending triangle breakout pattern. If TSM can clear that resistance on the open, it becomes the immediate AI alpha leader for 2026.
And the other one?
Micron Technology, MU. Institutional fresh money loves to target high momentum laggards that are trading at good valuations.
And MU fits the bill.
It's trading at a deep discount, under 10 times 2026 forward earnings. If institutional capital comes back in force on January 5th, MU is a very attractive place to deploy that cash.
So that brings us to the summary. 2025 was a year of incredible resilience, but the market ends long on price and decidedly short on conviction. It's waiting for the true institutional battle to begin.
And that fear, that insurance purchasing in the VIX. That's why the pros didn't play the Santa Claus rally. They're waiting for the other shoe to drop. This raises an important question for you, the listener. What specific piece of non-consensus economic data, beyond the known January 9th payroll report, do you think the smart money is hedging against that could break this brittle bull structure? Something that hasn't made headlines yet is keeping them up at night.
Something is definitely keeping them up at night. And now you are armed with all the key levels, the divergence data, and the setups you need for the new year, extracted directly from institutional strategy desks. We have successfully deep dived into your source material.